Happy Sunday, everybody. Julian here doing a video lesson. It's more of a request than anything, so I thought, why not put something together and share it with the people. So what we're going to be doing today is based on a question of, why is it that something moving pre-market fails? Or how do I know something that is moving pre-market is going to continue or fail? And the answer that I quickly gave to the question was, well, technical analysis will get you there. As a day trader and a short-term swing trader, technical analysis is the end all be all. Some people will say technical analysis just simply doesn't work. But the fact of the matter is that technical analysis is the only thing that is going to afford you the opportunity to make one red cent day trading. If the market opens at 9:30 and then spikes up 100% on some low float stock, there is zero that has changed fundamentally unless there's some absolutely huge news catalyst, and even still you have to overlay that with the technicals. But the technicals get you to where you're going. With that being said, I'm going to give you some insight into things that worked out. Here's one that we were trading the other day. Now this was a massive runner pre-market into the high of day. This thing moved up 520%. This is on par with what we hunt for. We have a scan for this. We hunt for these movers. We obviously never know until after the fact whether or not what we're looking at is going to be a big mover. In this case, it absolutely was. But every single day we just sign up, we do the same thing. We hit the scanner, scanner gives us results. We're looking at something very specific, waiting for something very specific to happen. Once we're given a high probability pattern, we get into the trade, we manage the risk, and then we see what happens from there. Now, with all that being said, the way that I knew that this was going to continue to run was based on the technicals. So we're going to use the technicals pre-market, and I'll give you an idea of what we're looking at. There's that big spike, and then price action sort of gets flat. We put in this little peak, and we're still staying flat, but you can see something very interesting first and foremost. The lows on the day are getting higher and higher, so that is a bullish sign, bullish signal. The other thing that we're looking at right through here is we're transitioning from overbought up here into an oversold situation. So these things suggest the price action is going to sort of correct itself and maybe make another take another swing at moving higher. So the first thing that we would look at if you're using the pre-market data is what's going on with the highs and the lows. And in this case, you can see that those lows are getting higher. The lows are getting lower, which isn't necessarily bearish in this case. The lead-in trend is bullish, and there was a catalyst here, and then we got our buy signal. So everything there collectively suggests that price action is going to move. The first thing that I look for specifically when the market opens is a run-up and a pullback. And you can actually see that there is our first run-up and then our first pullback. Now, to answer that question, how do we know if something is going to continue in the cash market after the pre-market? And the answer is simple. If price action runs up and pulls back, that pullback right through here, that is the sign whether or not price action is going to continue moving higher. If we get that run up or that rally and then that pullback and then that reversal pattern right through there, and then we transition higher, that is insight that price action will continue higher. To what degree, what level, I don't know. You would generally want to go back, like I usually do, check out where the major levels of resistance are on the daily chart and go from there. But in terms of what happens pre-market, how do we know that it's going to continue into the actual cash market? Is generally going to be a move higher with a light pullback and then a move back up to higher highs. Okay, so HKIB. This is going to be another example of what I just said. Pre-market activity right through there. You can see that price action runs up and then it pulls back, and then we're given some insight that we're going to see price action moving higher. A better understanding of that is even right through here, and this is actually a perfect setup where price action runs up, pulls back, puts in a floor. We get that buy signal on the MACD, and then all of a sudden, boom, we start to move, and there's that continuation of all of the information that you were getting pre-market. So that's one way to tell. Now I'm going to show you on the flip side, how do I know something's going to fail? And it's like, first and foremost, I don't know if something's going to fail, but what I'd be looking for was pre-market activity. It's on the scanner. We're looking for a move up, and then it pulls back. And one thing that I'd be looking at is the low, that first initial low. Is it going to hold and bounce, or is it going to breach and move to the downside? If it breaches and moves to the downside like it does right through here, there's a very good sign that this area is going to fail. And when it moves to the downside, I'm done looking at it. Another primary example is going to be MKD. I highlighted these to go over these to illustrate my point. Pre-market activity, a massive spike, no hold, no carry. It just spikes, drops, consolidates, moves bullishly out of the gate, pulls back, dips. You've got a little bit of trend line support in the cash market specifically. First initial low, secondary low, lows are getting higher, but there is a support level right through here. What happens if that support level gets taken out? Well, there's a sell-off. And that's how I knew that in real time that this initial move would not carry. Another point here is NVIV. You can see that there's a lot of pre-market movement. It's very, very bullish pre-market. Nice big bullish flag. I'll actually take this off. Nice big bullish flag. You create some consolidation through these two levels right through here. And essentially you have 107 high over 99-cent low, and that is a bullish flag. So the idea here is that bullish flag would play out if this level here cracked and moved long. But the idea also is that if this level down through here was to break, which it did, we would no longer be focused on this on a long side. And we would have to wait till that resistance level is then approached and broken long. And so that's generally how I look at stocks, and how I get an understanding as to whether or not something is going to continue or if something is going to fade. And when I'm usually putting these together in the morning time, I'll be looking at anywhere from 5 to 10 stocks. And, there are very, very few of them that will actually work out and move forward. Now, another point here, another question I was asked was about back testing. And this is something that I put in the blog today. And when it comes to back testing, very simply, and I'll shift gears here, is whether or not something is going to work in the future, you want to go back and back test to see how many times that thing has worked out in the past over 10, 20, 30, even 40 different trades and charts. And so I'll just use the S&P as a very simple example here. But if I wanted to back test what dip buying looked like on the long side of things, I might, for example, take a 15-minute chart, and then I will look at something like this. And this is just one example of back testing. I would look at every time price action moves up and then pulls back, how many times out of 10 does it break out of that level, that trend line resistance level, and pop to make new highs? And so that's a way that you would back test. Another example of back testing would be something like this, right? So you've got that nice bullish run up. It creates a bull flag. It then pulls back to about half of the run up. And then all of a sudden you look at, well, what happens at this point? And what are the similarities here that were seen back here? And you'll see that in these two examples, price action runs up. It takes out trend line resistance. There's a buy signal. It breaks. Price action runs up, it pulls back, there's a buy signal, and it breaks. And if we went over that over and over and over again, you will see that there is a common thread with how many times this happens and how many times it works out successfully. And here's another one, trend line resistance, price action has moved lower, and then all of a sudden we get up to that trend line resistance, it gaps over, and there's a buy signal. In this case, another pattern that you would recognize is pullback, buy signal, gap up. Pullback, buy signal, gap up. Pullback, buy signal, gap up. And that is, again, another thing that you would want to look at on back testing. So if I went over and did this, say, on an hourly chart, then the question is, how many times does it happen? How many times do I see it? How many times does that pullback, buy signal, gap up model show itself? How many times does it print a profit? And if you looked at 10 situations where it presents itself and 8 of those situations work, that's pretty positive data that you would then want to forward test in real time on paper, i.e. paper trading, or in a demo account. And if that works out and holds the same success ratio with a similar upside to downside trade ratio, i.e. 3 times the upside versus 1 times the downside risk, if that plays out on a forward paper test, then you would want to maybe look at testing that, front running that with an option, one contract. How many times does that thing happen? And put yourself into a contract position, like right through here. There is a run up, a pullback. We get a buy signal right down through this level. The MACD is bottoms up, and then we run. We see it here, we see it here, we see it through here, we see it through here, we're seeing it through here, and the same thing is presenting itself over and over and over again. So the thing about technical analysis is that history does give you a fair representation of what is going to happen in the future, because the markets are not independent of human beings. Human beings are the ones that are controlling the market. Human beings are creatures of nature, and so what we've done in the past is probably what we're going to do in the future, and that is just how the whole deal works. I realize that the markets are bigger than me. I don't ever try and pretend like I'm a bigger participant than the market. I just look at the market and I ask it, what is it that you're telling me, and where is it that I can take the information that you've told me and apply it in the future? I hope that makes sense. If you have any questions, please feel free to reach out.